The silver futures market is heating up right now, and everyone's talking about a big crash in March. But is it really going to happen, or is it just hype? Good morning, everyone. It's Tuesday, February 10th here in New York time, and I'm here on Market Signal to break it all down for you. If you're tired of lazy headlines that scare you without the facts, stick around. This could change how you see silver trading forever. Comment below what day and time you're watching this from. I love seeing how our signals reach around the world. And hey, if you value real market insights like this, hit subscribe right now and turn on notifications. It helps us fight off those copycat channels stealing our content. Drop Market Signal strong in the comments to show the algorithm you're with the real deal. Let's get into it. I almost didn't make this video. I was grabbing a quick coffee break, trying to unplug for a bit, when I checked the latest warehouse reports and margin changes. Boom, it hit me. What's really going on in silver? The big stories out there are missing the point, and you deserve the truth. So, on this Tuesday morning, let's keep it simple. I'll cover 3 key things. First, what's causing all this March panic and why the numbers look so wild? Second, why a total breakdown isn't the most likely thing, even though the market is under real pressure. The system has hidden ways to handle it. Third, what you should watch in the coming weeks so you're not just reacting to every rumor like it's an emergency. I'm not going by gut feelings here. I'm looking at the real data from public warehouse totals and recent margin hikes. These boring details matter more than any price chart right now. If you've been following metals news, chats with friends, or even that one buddy who thinks they're a silver pro, you've heard it. March will break everything. It might happen. It's a real worry. But I don't think we'll see a dramatic collapse like in the movies. Not because all is perfect. It's not. The system has tools, tricks, and backups that don't show up on charts. In a few minutes, you'll see why the stress is legit, but the end of the world scenario can get delayed. Let's step back. If you don't get what delivery means in silver, you'll panic over every scary post. Silver has 2 worlds: the physical stuff, bars, coins, metal for factories, and the paper world, contracts, promises, bets on price. Most paper traders don't want actual metal delivered. They just want to profit from price moves. That's key. When people say the exchange is out of silver, they mean the ready-to-deliver metal is less than all the paper claims that could ask for it. Paper grows fast, just clicks on a screen. Physical metal? You can't make it appear magically. Why March? It's a major delivery month, so it gets big attention. But the buzz started earlier. January and February were odd. January is usually quiet, people easing back after holidays. But reports show deliveries around 50 million ounces, way higher than normal. February hit about 20 million ounces too. It's not just the amounts, it's how many contracts stood for delivery instead of rolling over. Usually, only a small part does that, but more did this time. If that keeps up in March, where does the metal come from? Delivery isn't always a truck hauling bars across town. Sometimes, it's just a paper receipt switching owners. Or a warrant changing names in the same vault. The bar might not move at all, just who owns it. Or a private deal cancels the futures need without moving metal. So big delivery months don't always mean chaos. That's why you need to know 2 buckets in warehouses: registered, deliverable now, ready for contracts, and eligible. Good quality metal in vaults, but owned and not tagged for delivery yet. Eligible can become registered if owners agree, but they need a good reason, like money incentives. Registered might be around 100 million ounces on a day. Eligible could be hundreds of millions more. The gap is between available now and maybe available if convinced. Convincing costs cash. Fresh news: exchanges raised margins again recently. For the main silver contract, initial margins are now in the high teens %. Margins aren't exciting, but they're a tool to control risk. If speculation heats up, they crank margins higher. Leveraged traders must add money or cut positions, no choice. Ignoring margins while yelling default misses the point. These hikes come from volatility data and risk checks. Exchanges publish expected volatility from options. When it jumps, they act to protect the system. The promise is, the clearinghouse won't fail. Here's a quiet trick. The market pays for help. If deliverable metal is low, they offer better deals, higher premiums, better spreads, financing to get eligible owners to switch. Sometimes, private deals behind the scenes. Delivery talk acts like every ounce is new metal pulled from thin air. But often, it's reshuffling existing claims. Metal shifts owners or gets financed in loops that net out. Delivery shows stress but also normal moves. The real sign? Withdrawals. Metal leaving vaults entirely. If it stays inside, the system plays games longer. Why now? Industrial use is growing. Solar panels need silver. Demand could hit low hundreds of millions ounces yearly. Cars, especially electric, add more. Projections say 100 million ounces a year, soon as electrification grows. Data centers, grids, electronics. Silver's key for modern tech. Substitutes exist like using less per item, or recycling, but that takes time, not instant for March hype. Warehouse drops don't mean metal vanished. It could be reclassified, moved owners, or left. Ask why it dropped. Classification reverse is easy, withdrawals don't. March stress is real, but outcomes depend on choices. Who rolls contracts, who stands, who pays for metal, who takes it out. Price, spreads, fear influence that. Markets seem calm, then snap. Margins cut who can afford to stand as protest. Late February dates aren't magic, they're deadlines. First notice, last trade, assignments. Open interest matters more than its potential demands. But open interest isn't actual demands, it's possibilities. Behavior changes with incentives and costs. The math? Paper exposure hundreds of millions of ounces, normal for big markets. Deliverable, smaller. Nightmare. If many demand physical at once, stress hits, premiums, rule changes. But large players stand for financing, hedging, not home stacking. If metal stays in system, it lasts. Break comes when metal exits to private custody, paperwork to real shortage. Signs of tight demand? Yes. Solar, EVs, grids pull hard. Supply mostly byproduct of other mining, can't ramp quick. Surveys show deficits. Tight physical can coexist with paper crashes, margins force sales. Price down doesn't fix tightness, it flushes leverage. For March, Scenario 1. Many roll, margins cool volatility, it clears dramatically but okay. Scenario 2. System shifts, eligible to registered, ownership changes, looks strained but works. Registered stays low, stress to next month. Scenario 3. Big holders want metal out. Scramble, wild premiums, responses. Collapse idea. Good for punishing system? Careful, systems protect themselves. Rule changes, costs up, restrictions. We've seen it. Volatility, tweaks, winners lose. More chaos, not victory. What to do? Don't mix thrill with plan. Buying for March fireworks? That's gambling. No exposure. Price trackers give price, not metal. They diverge in stress. Physical? Where is it? Who controls? How fast access? Watch data. Deliverable totals. Eligible shifts. Spreads. Margins. Backwardation. Near price higher. Clues tightness, but not always. Could be financing. Verdict. Withdrawals, conversions, deadline behavior. Both sides wrong. Bulls say default sure, bears say all hype. Reality. System bends, survives, physical tightens slow. Contract size is big, pallets, not coins. Institutions control, not retail. Margins hit leverage. Eligible converts for incentives, premiums, rates. If exploding, rules would change fast. Now, incremental tightening, stressed but running. Silver and macro, dollar, yields, risk. Policy shifts cause swings. Physical tight, price dumps from forced sales. Futures work under stress if belief holds. March dangerous as story focal point. Registered low 100s millions, eligible higher, relies on cooperation, fragile near deadlines. Comment. 1. March stress real or trader narrative. 2. Silver for quick trade or long-term money distrust. Paper normal bigger than deliverable, for hedging. Dangerous if many convert. Margins change who hold. If you can't explain price versus custody, don't bet big. Pros use your fear. Share success stories in comments for motivation. Watch next. Eligible to registered shifts. Tapping buffer. Margins climbing. Volatility issue. Front spreads bid. Urgency. Deliveries. Leaving or shifting. Physical premiums high despite paper drop. Real constraint. Vaults concentrated. Efficient calm. Risky withdrawal. Logistics. Insurance matter. Question. Whose metal? Terms to move? Futures good for hedging, but casino on small physical causes episodes. Incentives misaligned. System protects. Don't bet on defeat benefiting you. Learn defenses. March. Messy. Volatile both ways. Yells of default. Nothing. System likely. Shift forward. Convert eligible. Raise leverage cost. Deter non-serious. Keeps running longer. Tomorrow. 1. Investor or gambler? Size down if can't handle drops. 2. No leverage in gappy market. 3. Physical hedge? Custody key. 4. Paper? No rules, margin risks. 5. Curious, not panicked. Panic donates to prepared. Uncomfortable. Collapse content like movie. You're in market. Pays for early, patient, disciplined. Watch March, delivery, buckets, margins. Own story. For more real breakdowns, subscribe to Market Signal now. Drop Market Signal strong in comments to support. That's the plan. See what happens. This is education, not advice. Do your research, know your risks.